one of the big things that I'm watching for the first half of next year, which I don't see a lot of people talking about yet, is the debt ceiling. Um, and so the debt ceiling is currently suspended in the United States, and at the beginning of January, it'll automatically go back into effect, which means the Treasury won't be able to issue net new debt. And since they're running a deficit, to keep paying their bills, they have to draw down their cash balance, their Treasury General account. And they got about 800 billion in cash there, which is currently their target level. Um, and so kind of like the first half of 2023, I mean, there's a debt ceiling issue in the first half of 2023, and they basically drained their entire TGA back into the financial system, which ironically is really good for liquidity when it's happening. Things get bad if they actually hit zero, but it's kind of like blackjack. If you go close but you don't go over, it's actually good for liquidity while it's happening. Um, and so whether or not we see a protracted debt ceiling fight in the first half of next year is one of the key variables that I think could influence market pricing. Um, and we have some, so the sample size is fairly small. It's the debt ceiling's been around for over a century, but it's only been used politically for the past decade and a half or so. And historically, we've had during that time we had three Democratic terms, two Obama, one Biden, and we had one Republican term, Trump. And so far, the Republican, when they were in opposition, they used it pretty frequently against Democratic presidents, but we didn't really see it used much by Democrats against Trump, but that was only one term, so the sample size is pretty small. So from what we have from history, if you get a Harris win, it's probably more likely to see the debt ceiling be used again in the first half of 2025 to extract some concessions. Whereas if you get the Trump victory, which is currently where polling and betting markets are leaning toward, I think would be less likely to get it, but it's still certainly possible because it's not a big sample size of whether or not Democrats will use it against Republicans.
Right now, the US Treasury has around $800 billion in cash. But come January, the debt ceiling kicks back in, which means they won't be able to issue new debt to cover their deficit spending. Instead, they'll be forced to drain that cash balance. And fast. Last time, in early 2023, we saw a similar scenario where the Treasury spent down their cash, ironically boosting liquidity in the financial markets. But this time, the stakes are even higher, with the debt ceiling used as a political bargaining chip over the last decade and early polling pointing toward a possible showdown. Lyn Alden warns that we could see liquidity conditions tighten or loosen dramatically depending on the outcome. Could this force a major market shakeup in 2025? With cash levels dwindling and political uncertainty high, the early part of next year could get volatile fast.
It's kind of like quantitative tightening. So for the TGA, basically, when they shrink that, it's kind of like QE. They basically are putting more liquidity back into the financial system because basically the TGA is their cash balance. It's an asset for the Treasury. It's a liability for the Fed. And that basically represents capital that has been sucked out of the system. It's kind of in this like void that's not really being used. So they've issued more bonds than they're spending by that amount. And so when they push it back into the system, they're basically spending without issuing new bonds because they're drawing down their cash balance. And that goes back into things like bank reserves and the rest of the financial system. So draining it is pro-liquidity, very similar to QE, and then refilling it is pretty similar to QT. I'm not really focusing on the refilling side yet because first we have to answer the question, is it going to be drawn down in the first half of 2025 or not? It's already at the target levels, around 800 billion that they currently want it to be at. And so there's no worry about refilling it anytime in the near future. It's really the question of would it be drained or not, or would it just roughly chop around at the current level? Is that, generally a draining TGA is pretty good for liquidity. It's not the only variable that affects liquidity, but it's a meaningful one. In recent, months, we're kind of at the lower end of workable liquidity in the system right now. So, for example, banks hit their lowest cash position back in March 2023 during the regional bank crisis. Ever since then, they've not dropped below that cash level despite ongoing QT. And that's because the reverse repo facility was drained back into the financial system. And that was in large part because the Treasury issued extra T-bills. They went above their normal allocation of T-bills, and that was able to basically draw money out of the reverse repos back into the system. That was good for liquidity. That's getting pretty close to being drained. They still have a couple hundred billion to go, but that's getting fairly drained. And right now, the biggest variable that matters over the next, not the 6 months that start at the beginning of the year, is really what's going to happen with the TGA, because that's such a big force compared to some of the other numbers there. Um, for a while, the repo facility that the Fed has was not really used. At the end of last quarter, it was used by major institutions to the tune of about 2 billion, which is very little, but it is a kind of a trend change. So that's something I'll be watching to see if that quarter ends, we'll start seeing more usage of the repo facility, because that's kind of indicative that there might be pockets of illiquidity in the system. Yeah, certainly. I try to not look too much into seasonality or presidential election cycles, even though they are relevant. I don't just think that that's the only variable that matters. During the first half of the Trump administration, the market was kind of rapidly pricing in tax cuts. So that, they did tax cuts without, for the most part, corresponding spending cuts. And so they basically did a stimulus when we already had an economic expansion. So it's kind of like rocket fuel. And then for the Biden administration, the first year was still fairly early in the recovery from the lockdown induced recessions, combined with stimulus that started under the later years of Trump with the stimulus checks and then continued under Biden. And so those were both pretty notable. You would generally expect that if we get a Trump victory, probably the market starts pricing in another round of tax cuts of some sort. And if we get a Harris victory, it's a little bit more complex because she has a mix of wanting to increase some taxes while keep others low. So we have to remember that some of the Trump era tax cuts automatically expire by the end of next year. So the fiscal was mostly wore off by that point. There was fewer kind of direct stimulus compared to 2020 and 2021. Then you had central banks around the world tightening interest rates, right, rising interest rates, and you had quantitative tightening. So that whole year was just down liquidity, rising rates, and fiscal that was way less intense than 2020 and 2021. By the end of that year, that's when you started to get the Treasury offsetting some of what the Fed was doing. They started issuing more T-bills. The reverse repo started draining back into the system. There's even been a paper by Nouriel Roubini and others called like activist treasury issuance that is like been cataloging how since the end of 2022, or especially since in 2023, the Treasury's been offsetting some of what the Fed's done for tightening. So 2022 is kind of the worst case for liquidity, fiscal, monetary all at once. Whereas in the other years, it's been more of a mixed bag. I think we're seeing a rotation to some extent. We've seen we've seen a lightening from some of the interest rate sensitive industries. They're the ones that have been kind of more impaired in this. And I think what's interesting is that by some metrics, we had a recession in 2022, even though we did not have an NBER-defined recession. So we didn't have an unemployment cycle, but we did have a credit tightening cycle. So if you look at senior loan officer surveys, banks got as tight for credit as they normally do in recessions. We also had rapidly slowing loan growth as a result of that credit tightness. And if anything, we're kind of coming out of that now. So we've been in this like environment, and also if you look back at that 2022 period, consumer sentiment reached recessionary levels, and the misery index, which is the sum of unemployment and inflation, that reached recessionary levels, obviously because of the inflation more so than the unemployment, which was pretty low. And now we're seeing there's less extreme negative for consumer sentiment. There's less extreme misery index. There's less extreme, banks are getting a little bit less tight with their credit than they were. So many of those are actually improving. But then the one variable that is starting to get pretty heavy is the whole unemployment situation. So continuing claims hit a new cycle high just recently. My general base case is that probably continues to inch up somewhat. But I do think that it'll probably reach a lower peak in this cycle than in many other cycles that we're familiar with. I think the 2001 recession is probably the closest recent analog that I would look at, which is to say a fairly mild recession, because in this current environment, when they're running 6 or 7% GDP deficits, we're in a fiscally dominant regime that can override some of the other factors and kind of change how a recession looks.
Now you know about the potential impact of the debt ceiling on market liquidity and what that could mean for early 2025. But to really understand the full picture, you're going to need to watch the next important video on this channel, where we dive into how these market forces are shaping up globally and what you need to watch out for next. So if you haven't already, make sure to like, comment, and subscribe for more insights that keep you ahead of the curve.